Welcome to the deep dive. It is Tuesday, June 16th, 2026, and I want you to just picture something for a second. Imagine a rocket sitting on a launch pad.
Okay, a big state-of-the-art rocket.
Right. Massive, gleaming, totally cutting edge. But you look underneath the chassis, and the vehicle is completely missing its engines.
Oh, wow.
Yeah, and there's zero fuel. Like, by every known law of physics, this machine should be firmly bolted to the Earth, yet somehow it is accelerating upward at the speed of light.
I mean, that is perfectly put. It's really the defining visual for, well, the financial anomaly we're dissecting today.
Exactly.
You've got this vehicle defying all known gravity, but, without the actual mechanical thrust to support its trajectory.
Right, because we are looking at an aerospace company burning through nearly $5 billion a year in net losses.
$5 billion?
Yeah, $5 billion. And yet, it is currently trading as the single most hyped stock on the planet, carrying a valuation well north of $2 trillion.
It's just staggering.
It really is. So, okay, let's unpack this. Our mission today is to just cut through all the deafening noise surrounding the SpaceX IPO.
Which is a lot of noise.
So much noise. We're synthesizing this massive stack of sources for you. We've got Morningstar valuation models, Goldman Sachs, macro reports, some really interesting systemic shifts in South Korean retail markets, and of course the raw S1 filings.
Right, because we're not just here to read the stock ticker to you.
No, definitely not.
We need to figure out if we are staring down the barrel of a historic tech bubble or, witnessing a fundamental paradigm shift in how we value equities.
And the SpaceX listing last Wednesday, that was June 12, is totally the epicenter of this entire debate.
It really is. It kind of forces us to reconcile the sheer scale of the investor psychology driving this market right now.
Oh, absolutely.
Because we are watching traditional valuation metrics just buckle under the weight of sheer speculative momentum.
Yeah, the actual pricing action is untethered from literally anything we have seen in modern market history. I mean, SpaceX listed at $135 a share.
Right. But by this morning, it has already surged past the 192 range. That prices the company between $2.1 trillion and $2.5 trillion.
Making it, what, the sixth or seventh most valuable public company on Earth?
Virtually overnight.
Yeah, virtually overnight.
Which means it's trading at an astronomical 115 times price to sales multiple.
115 times.
It's insane. Look at the historical comps. When Facebook went public in 2012, which, set records at the time, it traded at 28 times revenue.
Right, 28.
Even Palantir, which is famously priced for perfection, trades around a 67x multiple.
And SpaceX is dwarfing that.
Completely dwarfing the most expensive software companies in existence. All while acting as a heavy industry manufacturer that, like we said, posted a $4.9 billion net loss in 2025.
Right. And you really cannot view this euphoria in a vacuum either. The macro friction globally is intensifying.
Oh, totally. There's a lot going on.
Exactly. We just watched global equities waver heavily over the U.S.-Iran peace framework. Right. And just to be clear for the listener, we aren't taking any political sides here. We're just looking at how the market reacted to the news.
Right. Strictly impartial here. But after President Trump labeled reports of a $300 million payment to Iran as fake news, the immediate ambiguity surrounding that agreement caused a really sharp retreat across international exchanges.
The market definitely didn't like the uncertainty.
No, it didn't. And simultaneously, you have the Bank of Japan aggressively stepping in, raising interest rates to 1%.
Which is a level we haven't seen since 1995.
Exactly. So you had tightening monetary policy in Asia, severe geopolitical tension in the Middle East, yet this tech hype train just continues accelerating as if the macro environment doesn't even exist.
Yeah, that complete disregard for the macro environment really brings up that money printer go brrr conditioning mentioned in our sources.
Oh, yeah. The meme.
Right. It started as an internet joke, but it perfectly encapsulates this deeply ingrained monetary psychology.
It really does.
I mean, we had years of post-pandemic quantitative easing where the Federal Reserve slashed rates to 0.25% and injected $700 billion into bonds.
Massive liquidity.
Just flooded the system. And that essentially trained an entire generation of market participants to reward growth at any cost and, completely ignore cash burn.
Right. And the hangover from that zero interest rate environment is a market that fundamentally believes liquidity will always arrive to cover up structural deficits.
Are we just looking at a market so physiologically addicted to that financial sugar rush that buyers are throwing capital at sci-fi concepts without running the basic arithmetic?
It seems like it. But financial gravity eventually demands that a $2.1 trillion valuation be tethered to cash flow.
Yeah. Eventually, the math has to matter.
Exactly. If SpaceX is operating at a multi-billion-dollar loss, that premium isn't reflecting their current space dominance. We really have to deconstruct where the market believes this capital is actually going.
Well, doing a sum of the parts valuation reveals a pretty glaring distortion in how this company is being priced right now.
Let's break it down.
Let's break out the subsidiaries. So, Starlink is the crown jewel of their current operations, right? It's highly profitable, expanding aggressively.
Right.
The most generous estimates peg Starlink's standalone value around $171 billion.
Okay, 171.
Then you have the core space launch business, the Falcon 9s, the heavy lift vehicles, the defense contracts,
The rockets.
the rockets. Based on traditional aerospace and defense multiples, that segment is worth roughly $21 billion.
Okay, so if you subtract that 171 billion and that 21 billion from the 2.1 trillion total market cap,
You are left with an implied valuation of $1.9 trillion being assigned almost exclusively to XAI, their artificial intelligence division.
1.9 trillion for XAI alone.
Just for XAI.
Yeah.
And to put that in perspective, OpenAI, which is the undisputed pioneer in the space, was recently valued around $850 billion.
So the market is pricing SpaceX's internal AI division at more than double the industry leader.
Yes, and here's where it gets really interesting. You read through the S1 filing to see what XAI is actually doing to justify a valuation larger than the GDP of most countries.
And what did you find?
Well, they are currently generating about $26 billion a year in revenue.
Which is a lot of money.
It is. But they aren't making that by selling a revolutionary AI product to consumers. They are making it by acting as a digital landlord.
Ah.
Yeah, they're renting out the idle compute capacity at their Colossus One data center in Memphis directly to their competitors.
What's fascinating here is the sheer fragility of that revenue architecture.
Oh, it's incredibly fragile.
Because the breakdown shows Anthropic is paying XAI $1.25 billion a month.
A month.
A month. And a recent contract amendment reveals Google is paying $920 million a month for access to roughly 110,000 NVIDIA GPUs at Colossus.
Which is crazy because the S1 explicitly frames this as the monetization of idle compute.
Right.
SpaceX built this colossal supercomputer to train their own foundational model, Grok. But Grok's utilization rate is sitting at a dismal 11%.
11%.
Yeah. It's like, think about it like this. It's like building a massive state-of-the-art bakery to sell your own proprietary bread. But nobody's buying the bread, so you're surviving by renting out 89% of your ovens to the rival bakery down the street.
That is a great analogy.
Right. I mean, it generates massive cash flow today, sure, but it completely undermines the narrative that XAI is an unstoppable product powerhouse.
Especially when you examine the actual lease terms.
Oh, the lease terms are wild.
Right. Those rental agreements with Google and Anthropic contain 90-day cancellation clauses.
90 days.
Just 90 days. You have Anthropic literally using XAI's hardware to train foundational models that directly compete with and, currently outperform Grok.
Yeah.
So once Google and AWS finish building out their own massive sovereign GPU infrastructures, which, by the way, is projected to happen by late 2026 or 2027.
Which is right around the corner.
Exactly. Those 90-day cancellation clauses will be triggered en masse. What happens to that $26 billion run rate when the rivals pack up and leave?
You are left holding a massive, depreciating supercomputer with an 11% internal utilization rate.
Exactly.
So that $1.9 trillion valuation is resting on a revenue stream that could be legally evaporated in a single fiscal quarter.
Which really brings us to the profound disconnect between the company's internal narrative and how independent financial models are projecting this out.
Let's talk about the models.
Well, Elon Musk recently stated SpaceX will cross $1 trillion in annual revenue by 2030.
1 trillion.
Right. That requires an unprecedented 50-fold increase in top-line revenue over 5 years.
Wow.
Now, Goldman Sachs, who notably earned massive underwriting fees pushing this IPO to market, they project a much lower $474 billion by 2030.
Okay, so less than half of what Musk is saying.
And Morgan Stanley models it even lower, at $330 billion.
And those are the banks that actually have a vested interest in the stock performing well.
Right, they underwrote it.
Exactly. So then look at the independent research from Morningstar. Without any underwriting fees clouding their math, their deep dive probability model calculates the fair value of SpaceX at exactly $63 a share.
$63.
Yeah. That is a 53% discount to the IPO price and just a catastrophic drop from the 192 it is trading at today.
Morningstar didn't just throw a dart at a board here,
No, they did the math.
They built a really rigorous three-scenario model for the orbital AI business.
Walk us through it.
So scenario one is the moonshot, which they assign a mere 7% probability.
7%, that's tiny.
Very tiny. This assumes Starship rockets achieve 85% rapid reusability and successfully deploy 59,000 orbital data center satellites by 2035.
Basically capturing 20% of the entire global AI compute market from space.
Exactly, that's the moonshot. Scenario two is the MVP, the minimum viable product. They give this a 50% probability.
Okay, a coin toss.
Right. In this one, a constrained satellite constellation is deployed, but completely fails to dominate the market.
And then there's scenario 3.
Scenario 3 is the no-go, holding a 43% probability. In this model, orbital data centers run into insurmountable latency and power constraints.
Basically, the physics simply don't map to the economics.
Right, and SpaceX abandons the project by 2028, resulting in an $82 billion total value destruction.
Wow. So the math is incredibly stark.
It really is.
To justify buying this stock at the $135 IPO price, you have to entirely reject Morningstar's probabilities.
You'd have to ignore them completely.
You are essentially pricing in a 77% probability that the moonshot scenario executes flawlessly.
Which is wild.
And even after factoring in that impossible success rate, buyers are still paying a $72 per share option premium.
Just for the privilege.
Right. You are paying an extra $72 a share today for the sheer privilege of hoping their unproven, decades-out ambitions like, lunar chip fabrication or Mars colonization somehow become cash flow positive.
It's quite bad.
So why are the institutional buyers completely ignoring the independent math?
Well, if we connect this to the bigger picture, the reason the math is being ignored is because the actual mechanics of price discovery in our current market are structurally broken.
Broken how?
When fundamentals like revenue, profit margins, realistic growth models, when they fail to justify a price, you really have to examine the plumbing of the stock market itself.
The plumbing.
Yeah. We are looking at a perfect storm right now of low-float, forced algorithmic buying and aggressive global retail herding.
Let's look at that float constraint first. SpaceX didn't list their entire massive operation, right?
No, not at all.
Only 4.3% of the company's shares are publicly tradable.
4.3%.
So you have a $2.1 trillion company, but only about $80 billion worth of stock is actually changing hands.
Right. And due to the sheer size of the implied valuation, index providers fast-track SpaceX for inclusion into the NASDAQ 100 and the MSCI World Index.
Which is a huge deal.
It's massive because the moment that happens, passive index funds are structurally mandated to absorb the stock.
So the Vanguard and BlackRock ETFs sitting in millions of 401k accounts, they don't run a discounted cash flow analysis.
Nope.
They don't read the Morningstar report.
They don't care.
Right. The algorithm simply sees the company added to the index, and it executes a buy order at whatever the market price is.
Exactly. And analysts calculate that inclusion triggered roughly $30 billion of forced price-insensitive demand.
$30 billion.
Yeah. You have a $30 billion fire hose of capital trying to force its way through an $80 billion garden hose of available shares.
What an image.
And that mechanical imbalance violently drives the price upward, entirely divorced from the fact that the company operates at a $5 billion loss.
It just replaces human valuation with blind algorithmic consumption.
It does.
But, it's not just the passive funds breaking the pricing models. The retail sector has evolved into this massive global coordinated force.
Oh, absolutely.
Look at the data coming out of South Korea right now. Retail investors aren't just gambling on penny stocks anymore.
No, they're not.
They're wielding enough capital to treat legacy blue-chip conglomerates like meme stocks.
The South Korean market is providing a flawless microcosm of this psychological shift.
Tell me about it.
Well, individual retail investors have essentially formed a collective monetary bloc. They net bought 9 trillion won worth of equities, overpowering and breaking the influence of foreign institutional investors who net sold 10 trillion won.
Wow. So the historical paradigm where institutions set the price floor is just dead.
Completely dead. Retail momentum dictates the valuation now. We just watched Samsung, which is a globally entrenched tech titan nearing 1,000 trillion won in market cap experience, a 30% plunge in a pre-market anomaly.
30% for Samsung.
Yeah, driven purely by shifting retail sentiment.
While on the exact same day, Hanwha Solutions spiked violently just because Elon Musk mentioned the theoretical concept of solar power in space on a podcast.
Exactly.
Hanwha's balance sheet didn't change, their quarterly projections didn't change at all, but the retail herd moved the underlying asset price anyway.
Because narrative drives the price.
Right. And that exact same retail herd is currently piling into the 4.3% float of SpaceX. But if you are watching that ticker hit 192 and feeling the fear of missing out, you really have to look at the lockup calendar.
You have to. The current low float is an artificial environment.
Totally artificial.
Lockup agreements are standard contractual mechanisms.
Yeah.
Right? They prevent insiders, executives, and early private investors from dumping their shares on retail buyers the moment a company goes public.
It stars the market of supply to keep the initial pricing buoyant.
Exactly. But those agreements always expire.
Always. And SpaceX engineered a staggered release, and the timeline is basically a ticking clock.
Tick-tock.
Right. In September 2026, 20% of the insider shares unlock and become freely tradable.
20%.
Then directly following their Q3 earnings report, another 28% hits the open market.
Wow.
And then the dam breaks in December 2026, where a massive cliff of remaining insider stock becomes liquid.
And the moment that new supply hits the order books, the market mechanics violently reverse.
Becker Hose turns off.
Exactly. The algorithmic index funds have already completed their forced buying. The retail momentum is fully saturated. So suddenly you have billions of dollars of newly tradable equity crashing into a market with totally exhausted demand.
And we have watched this exact bloodbath play out with every major hyped listing of the decade.
And time again.
Look at Palantir. It soared from $10 to $40 riding retail mania, but the day the lockup expired, the stock cratered 13% in a single session.
Brutal.
Rivian lost 20% on its lockup date. Uber plunged 40% from its IPO price, hitting all-time lows when insiders finally secured their exit liquidity.
So if you are buying a piece of that tiny 4.3% float at $192 today, you are volunteering to be the exit liquidity for the executives cashing out in December.
Let that sink in.
Yeah, and this raises an important question that extends far beyond Elon Musk and XAI, you know.
Where are we headed?
Well, when you step back and look at the broader equity landscape, the global market is showing unprecedented top-heavy concentration.
Very top-heavy.
The parallels to historical manias are unavoidable. Are we simply living through 1999 all over again?
The concentration metrics are staggering. I mean, the technology sector completely dictates the global economy.
Totally.
NVIDIA is carrying a $5.1 trillion market cap. Apple and Alphabet are sitting at $4.3 trillion each. Microsoft is at $3.0 trillion.
Huge numbers.
The top 10 companies in the United States now account for 25% of the entire global equity market.
And the velocity of capital is accelerating, too.
Oh, yeah.
IPO and M&A activity is running hotter than we have seen in 25 years. First-day IPO premiums are averaging 30%.
30%.
Yeah, which is a metric last seen at the absolute peak of the dot-com bubble. You even have highly respected market veterans like Ed Yardeni publicly predicting the S&P 500 will cross 10,000 by 2029.
10,000.
Right, propelled by an $89 trillion wealth wave as baby boomers transfer their assets into the market.
See, that sounds like the textbook definition of a bubble. Unprecedented index concentration, skyrocketing IPO premiums, unprofitable companies selling sci-fi narratives for trillions of dollars, and Wall Street veterans claiming the party will never end.
It definitely exhibits all the classic symptoms of irrational exuberance. But Goldman Sachs recently published a massive systemic review delivering a surprising verdict.
What did they say?
They said, we are not in a bubble.
Wow. I'm going to heavily push back on that.
Thought you might.
How does Goldman justify looking at a 115x sales multiple on a company losing $5 billion and determine the market is acting rationally?
Well, Goldman's thesis rests on the structural health of the balance sheets driving the broader market.
Okay, explain that.
The dot-com era was categorized by poorly capitalized, nascent startups burning through dangerous levels of high-interest debt to fund their user acquisition.
Right, pets.com and all that.
Exactly. When the credit markets tightened, the debt crushed them, triggering systemic bankruptcies. Today, the titans pulling the market upward, like NVIDIA, Microsoft, Alphabet, they are funding their historic capital expenditures using their own internal mountainous free cash flow.
So they have the cash on hand.
Exactly. They aren't heavily leveraged. The
Wow.
foundation of the market is built on cash, not toxic debt.
So What does this all mean for the average person listening? Goldman says they won't go bankrupt because they aren't swimming in debt. I get that.
Yeah,
But if you buy a stock at $192 and it drops to 63 because the growth expectations were physically impossible, your portfolio is still decimated.
absolutely.
A 60% multiple contraction hurts the retail buyer exactly the same as a corporate bankruptcy. Does Goldman acknowledge the valuation risk at all?
They do. And they define it not as a debt crisis, but as an overinvestment crisis.
An overinvestment crisis.
Right. These tech conglomerates are pouring hundreds of billions of dollars into scaling AI infrastructure. They're securing land for data centers, building proprietary power grids, hoarding advanced chips.
It's an arms race.
It is. And the true systemic risk is that this massive capital expenditure cycle completes, and the downstream AI applications fail to generate the proportionate financial returns required to justify the build-out.
Ah. You build the world's most expensive infrastructure and then realize the software running on it only generates a fraction of the necessary revenue.
Exactly. The underlying businesses will survive because their balance sheets are fortified. But the stratospheric valuations attached to their stock tickers will violently correct back to historical norms.
You are watching a historic tug-of-war playing out across the global markets right now.
We really are.
On one side, you have the raw, unbridled power of retail capital, the cold, blind execution of passive index algorithms, and the undeniably intoxicating narrative of humanity conquering space and achieving artificial general intelligence.
It's a great story.
It is. But on the other side, you have the inescapable gravity of a $5 billion cash burn, a $1.9 trillion AI valuation propped up by 90-day rental agreements with direct competitors,
Yeah.
and a massive supply cliff of locked-up shares preparing to flood the market this December.
It is the ultimate collision between speculative narrative and uncompromising mathematics.
Leaves you with one final thought to process today. We are watching trillion-dollar valuations increasingly tethered to the premise that humanity's future requires becoming a multiplanetary species or, deploying tens of thousands of data center satellites into low Earth orbit to escape terrestrial power grids.
Ambitious goal.
Very ambitious. But what happens to the global index funds, and by extension, the core of your own retirement account, if, after trillions of dollars are spent, society ultimately decides that the economics, the physics, and the reality of staying on Earth just make more sense?
That is the multi-trillion-dollar vulnerability hiding right in plain sight.
We started today with a rocket on a launch pad, accelerating into the atmosphere with no engine and no fuel. It is a spectacular thing to watch. But eventually, gravity always checks the math.